We're here to talk about the jobs report today, out this morning, Friday morning, that is April 5th. I'm here with Michael Gayed. He is the ATAC Inflation Rotation Fund Co-Portfolio Manager at Pension Partners, and Aneta Markowska. She is the Chief U.S. Economist at Societe Generale. Thanks so much for being with us today.
Thank you.
So you guys are probably a little bit on the higher end. Michael, what are you guys looking at?
Well, what I'm looking at is what the bond market has been saying for the last 3-4 days. You see a pretty substantial drop in yields, inconsistent with where the stock market thinks we are in the economic cycle. And I'm also looking at the behavior of very domestically sensitive areas of the stock market, most notably U.S. small caps, which the last 3-4 days have also very substantially underperformed global large caps. So the market does seem to be concerned that you're going to have a very poor jobs number coming up.
Okay. So I guess we might be having the numbers coming in here in a second, but you know, what we were expecting was about 200,000 jobs, according to consensus among economists. And we're looking for hours worked per week, 34.5, which is the same as last month. And we were also looking for the rate to remain unchanged, which is what Aneta had said.
Very off.
So it was 88,000 jobs were created in March, which is far below the. It's the smallest gain in 10 months. It's well below what we were expecting. Aneta, can you jump in real quickly? Tell us what do you think of this number?
I'm really surprised by it, I have to say. If you look at where the GDP and demand is tracking in the first quarter, we're probably going to see Q1 GDP in excess of 3.5%. You know, there are some seasonal quirks with the weather. We'll have to take a look at those. The sequester might be a factor, but I am surprised that it is, you know, it is out of line with a lot of other data that we're seeing.
Okay, Michael?
You know, just looking at the reaction, you know, afterwards here, looks like bond yields are falling. Bond yields are falling even further, which is consistent with the deflation pulse.
So we're hearing that the February number was revised upward to 268,000, which is much better than the 236,000 that we heard last month for the February jobs number. A lot of people I was talking to, Michael and Aneta, were saying they didn't expect that the number would, for February, remain as high as it was. It actually went higher. So a quick reaction, Aneta, you first. What do you think? The previous number revised upward, much better. This month, really not so good.
You know, you always have to, these numbers are quite noisy. It's definitely weak, no question about it, but you have to take this in a broader context. You know, we have been running above 200 for a couple of months. You know, just look at the average. It's still decent trend that we're on. We were looking for some softness in the second quarter on the back of the sequester, and you know, also business investment jumped very sharply in the beginning of the year. You had the sort of the cliff-related drop in uncertainty, and maybe that's fading off a little bit. So there's some one-off factors going on. When you look at the fundamentals in the underlying economy, housing and home prices rising, business balance sheet still very healthy. You know, to me, the medium-term outlook is quite healthy. We could see softer second quarter numbers, again, the sequester being a factor. But when I look a little bit further out to the second half of the year, I think we'll see a continued improvement in employment numbers.
So Aneta, you're still pretty optimistic about the general rise. Michael, I don't know if you are as much. What do you say?
Yeah, look, I mean, from an investment strategy standpoint, you've had this massive disconnect. The bond market has been telling you one thing, the stock market has been saying something else. Now, this jobs report does seem to indicate the bond market had it right all along. And we know that the bond market tends to be much more right than the stock market. Now, the entire reason for the bull move this year has been that you have QE and that you're going to have essentially continued money printing, which will eventually filter through to the economy. But now that's not happening. So we do have to wonder, I think, if we are on the verge of a much more meaningful correction that people are probably not prepared for to resync to that deterioration.
Aneta, what do you make of that real quickly?
You know, I definitely agree. We've had a pretty good run as far as risky assets. I'm not a strategist, so I don't really want to comment too much on that. But you know, certainly the data has been getting a little bit softer, and I wouldn't be surprised if we see a correction here.
Sure.
But you know, again, when I looked at the second half of the year, I do see some underlying improvements in the economy. Housing, which has been the key structural headwind to growth over the last few years, I think it's becoming a tailwind. So you know, on the medium-term view, I remain quite positive. positive.
Well, Aneta, thanks so much for being with us. We appreciate your time.
Good to be here.
All right, take care. That was Aneta Markowska. She is, of course, the chief U.S. economist at Societe Generale. Michael, you're going to be able to stay with us. Let's kind of dive back into this. One of the other numbers that we just got fed in is that the wages dropped, it looked like a cent, to $23.82. Excuse me, that's about the same. Essentially, we're looking at a number in which the unemployment rate comes down. Yeah. And there's been tons of talk about, well, the unemployment rate can go up and down, and it really doesn't. The math is not the same as how we calculate non-farm payrolls.
Right.
Non-farm payrolls don't come in very strong. The jobless claims yesterday were also weak. ADP private payrolls came out on Wednesday. They were weak. But we've been through 4 or 5 years of looking at jobs numbers, and I mean, last year, at the first half of the year, jobs numbers for 3 straight months were excellent in the non-farm payrolls. And then we kind of dived off, and then by the time the election was coming back, numbers were decent enough, right, in which it didn't seem like too many voters and too many average Americans felt as if it was something that you should blame on the current administration, and maybe a lot of people in Congress. The Senate and the House both pretty much stayed in the same power. Little change here, little change there.
Sure.
That's a lot of context. What I'm saying is, we've seen this before.
We have seen this before, and we've seen the reaction before a number of times too. You know, it's clear that deflation expectations are actually rising despite this $85 billion a month. So if we're talking about context, there are 2 sources of inflation. Demand pull, which is driven by jobs picking up and by consumer demand, and cost push. Now we know cost push has been very weak because commodities, which are the component of cost push inflation, have been falling off a cliff this year while equities have diverged on the upside in the US. Now, the whole demand pull argument for inflation, or reflation, I think is going to very much get questioned here by stock investors. And you have this, you go back to the whole pushing on a string type of argument. Can all of this ultimately result in an acceleration of economic activity? Right now, it really doesn't seem that way.
Mm-hmm. Yeah. I guess one of the final things is for someone on my side where you just report about these things. There's no, I'm not trying to position myself one way or the other. But what I heard last month was a lot of skepticism. Hey, we're not so sure if the 236 number is all that great. It actually ended up being better. And then I don't know what I'll expect to hear from people today, but Aneta already being still a bit optimistic, saying there's no reason to run away. I think maybe you would in some ways maybe agree. Do you? I mean, do you think we're on a general uptrend? Of course, it's not huge. We're not seeing 3-4% GDP growth. We're not seeing 300,000 jobs added a month. But are you still optimistic that we will see growth in the labor market?
Yeah, no, I think so, because if this fear trade does persist, yields presumably will go even lower, which then adds further stimulus at some point later in the second half. So I actually do agree with that. But I think just psychologically here, we're at a very nasty juncture, because you have now shifted away from new all-time highs to now the economy being weak and maybe the possibility of the mother of all triple tops in the stock market. That can bring back a lot of gray-haired bears.
Well, Michael Guyette, thanks so much for being with us. This is Michael Guyette. He's the ATEC Inflation Relation Fund co-portfolio manager. You may know him as being from Pension Partners. I'm Deaux at TheStreet. Take care.